Mine was like 9 houses.
Wait, what?
But then it wasn't the best part of it.
No.
No, mine's right after we were done.
In here.
Okay.
My clust.
Hey, real quick, you need your notes out for right now. What we're going to talk about today is we're going to go through 4 different things right now. Okay? This is, just to warn you, this is the last section of the chapter. I said it was getting kind of close to the end here.
Yeah.
So, here's what we're looking at. Today, we'll do notes. Tomorrow, we'll get homework. Wednesday, Thursday, we do review. Friday's your test in here. Did everyone hear that? We have a test on Friday. I'll give you your practice test probably tomorrow, just so you can see it. The charts and whatever formulas you have will be on the board, whatever you need that day. I'll kind of show you when we get to review days what will be on the board that day, and they'll kind of cycle through. But today, we have a lot of stuff to cover. You want to write down this stuff as much as possible. I'm going to have both videos online tonight just to see which one you like. I'd like somebody to at least watch 1 or 2 of them. Not the whole thing, just watch a clip and see which one you like, which one looks better, which one sounds better, that type of thing. So I'll post those tonight if I can. Alright, so, okay, real quick here, what you're looking at here, this chart is the mortgage chart for 30-year mortgage and interest payments. I know that we already covered mortgages. The goal today is to talk about insurance and to also talk about the interest that you paid on your house. Now this chart is probably not realistic unless you have really bad credit. I'll give you an example of like what my parents paid back in the 70s when they first built their home versus what I paid for my home. And you can kind of see the difference because our homes were relatively about the same price, but their interest was a lot different. So I want you to just kind of see that. So here's the idea. So let's say, and this will eventually get to our new section today. Let's say that we're buying an $80,000 home. Okay, $80,000. And we're going to take out a 30-year mortgage, 30-year term. That's what they call it. Okay? Now, it depends on what kind of credit you have. Back in the 70s, credit score really didn't apply. It was just whatever you went to the bank. They had a default credit for a home loan, for a mortgage. Okay, what are you looking for? It's back there.
It's right there.
It's right there.
This is Monday.
Okay, yeah. Alright, so 30-year mortgage, $80,000. It depends, so here's your $80,000. Ignore this red arrow here. $80,000. And let's say, and this is a real fact, my parents paid 12% interest back in the 70s. There wasn't an option, didn't matter what your credit score was. My parents had really good credit back in the 70s. They had a 12% interest. That's insane. What you're looking at here, so on 12% interest, that is a lot, it's crazy. For 30 years, their house payment was $823 a month.
What section is this one?
This is the last section, so this would be 4.8 and 4.9. So we're mixing 2 together. So yeah, section 4.8 and 4.9. So what we're talking about today is we're going to talk about your mortgage, and more importantly, is the actual insurances that are covered under. So insurances, because we covered everything. We talked about gas, utilities, we talked about usage of them, we talked about how to read the meters and whatnot, but now today is about actual payments and insurances that cover it. Question?
So is this like real?
Yeah, this is a real number. This is real. Like this chart is based on the real numbers of it.
So is that like more or less than what is like now?
Oh, way more than what it is now, because your interest rates aren't 12% anymore. When I bought my home, it was 4%.
Oh.
So we're gonna see the difference here. Okay. Now, what this chart is, and by the way, most banks have these charts. They have the charts for 20 or 30, 25. I think they even have a chart for 50 if you were in that bracket where you could do a 50-year loan. They don't do that for most parts. They do have that select group that you could. Okay, question?
Why isn't it 12 anymore?
12%? 12% is insane. No one would take out a loan. 70s, because no one had an option. It was like you could go shop around at different banks. Because nowadays you can go online and just check with a different bank.
They did this basically just to get money.
Yeah. Yeah, it was just like, it was total price, it was a total price gouge. You couldn't escape it. Every bank in Missouri did it. And we didn't have the internet, you know, in the 70s, so you couldn't go online and go, hey, could I get a loan through a bank in California that would supply me with my loan, because they'd give me a 3% interest loan. You can't do that. Well, they kind of knew their market. Well, here's the idea. $823 a month. If you take 823 times 12, and then you take it times 30, this will tell you what the price you paid on an $80,000 home in 30 years. It's insane. Now, there's a whole reason why I'm doing this, because we have to talk about insurances as well. Okay, so 823 times 12 times 30, you're paying $296,000 for your home. 280. Now, just to let you know, my parents, I think they built their house in 1972, so in 2002 they had it paid off. That's a good feeling. When you see that you don't have that money coming out of your bank account every single month, they were finally paid off. Now, if you put a remodel, you can do a remortgage and get a higher loan. You'd start the whole process over again, and so that's why a lot of people don't do that. They just save up their money, or they take out a small interest loan. But yeah, that's a lot of money. Now, to give you an idea, my home that I bought was about the exact same price. It was 83, but we'll just say 80 for purposes. $80,000. We went 30 years, but my interest was about 4%. It was actually 3.5, but we'll just round it to 4 for ease purposes. Now, 30 years, sorry. 30 year, 4%. I just want to show you the differences here. Now, do you agree that this chart doesn't go down to 4%? This is an older chart, it doesn't go down there. We have that formula that we talked about last week, 80,000, that's your principal. You take it times 1 plus your rate, divided by how many times they compounded the compounds for the years. This is the formula that we use to calculate, mortgages. Notice the 4% is 0.04. A lot of people were doing that wrong last week. 0.04 is interest. You divide it by 12, you add that number to 1, and then you put it to the 360th power. So 0.04 divided by 12 is a very small percent, 0.003333 repeating. We add 1 to it, and we put it to the 360th power, which is, if I do this all correct, this whole thing back here, even to the 360th power, is 3.313498, and it's $80,000 home. So if I took this times $80,000 home, I get $265,079.84. Now, you're thinking that's not that big of a change.
That's
$30,000, $34,000 difference, just because of the difference in year.
I could use them.
Yeah, that's a pretty big chunk of change. That's a pretty nice car that you can add to the collection, or a pretty nice garage, or something else you're going to build other than the home. Okay, you're saying 1970 versus 2018, or actually it was 2011 when I bought my home, so quite a difference in years.
On test day, do we get the formula?
Yes, that formula will be on the board and I'll have them labeled. Okay? Yeah, because there was one section we had to find mortgage when it was a different percent. Now, that's how these charts work. Most banks have them. They'll instantly tell you what your payment is, so you can see, can I even afford that loan? $800 is a pretty tough loan for 12%. Why would be this big of a discrepancy in percents nowadays? Your credit's bad. You have a bad credit, they don't trust you enough, they're going to make that payment a lot higher to either discourage you from taking the loan from their bank, and or if they are, they're going to make some money off of it. So it's not a great situation. Now, if you want to know what the interest paid, like the extra money you paid to the bank, what you do is you do this. So if you take whatever your payment was, your total pay, and you take the $296,280, that's what my parents paid, $296,280, and you subtract the original loan at $80,000, they're paying the bank $216,000 to take out this loan for 30 years. That's a lot of money. But that's paying for all the money that they borrowed from the accounts they borrowed from, all the employees, the lights, everything. They have to make money on that, otherwise they don't have a bank to be open, because you do have to pay employees to actually do that. Now, to me, it's a little ridiculous. They're making 3 times the price of your home in just interest. Okay? That's what your student loans do. That's what a credit card does. That's why I kind of warned you, you need to be scared of those things. Because the more you take out, the more money you're paying back in the long run. Okay, you're not going to just pay whatever you borrowed. You have to pay the interest on top. And your interest in student loans are about 9–10% input. And you can't renegotiate that unless you consolidate. All right, so that was the first example. Second example today. So let's go to the second example here. That's perfect. Okay, second example. This is another chart that the bank will possibly provide you if you're not going to go with a 30-year loan. Now this is out of your book. I'm not joking. This chart was identical to what the banks provided me when I was sitting down and talking with the actual loan officer that was in the bank. Okay, they provide you something like this. Theirs went down to 3 and 4 and 2% interest if you could get a loan like that. But what you're looking at here is what you're going to pay per $1,000. So on your home. So I know this seems a little weird. So the idea is that I'm going to go to my $80,000 home, but I'm going to do it for my parents here so you can see this. It's actually pretty close to spot on. Okay, so I'm going to try to use my parents as their example. Okay? All right. So my parents said they're going to take an $80,000 loan out for 30 years, and their percent was 12%. So how this works, what this chart is, you find your 30 years, you find your percent, and this number is the actual number that's in your monthly payment in terms of years. Okay? Now, the difference here could be is that the difference is that they probably rounded significantly, and or this could be where they might use a chart where they add in like escrow, they add in the taxes, land taxes. Now this was actually pretty accurate though. So how do you do this? 30-year loan, 12% interest, that's the 10.29. What that number is, this is what you're going to pay per $1,000 for every 1,000 of the house you're borrowing. So this is a chart they provide you. It's an easier chart, and usually this chart is significantly easier to read. It's not as big, and you can see the different years that are involved here. So the idea is that how many $1,000 home am I going to purchase? I'm buying an $80,000 home, right? So that's 80 thousands, right? So you take 80 times the 10.29. Does everyone understand where I came with the 80? You have to think about how expensive your home is. It's an 80,000, so that's 80 for the number I'm using, and that's what you have to multiply by that number sitting in that box. So what I always do, whatever the price of home you're buying, just chop off the last 3 zeros. That's what you do. And that's what you multiply by. Now, if you actually multiply this will actually tell you that price. So 10.29. So 10.29, we take it times 80. It's an $823 payment. Now, this is a little more accurate than the last chart. The last chart kind of rounded too much. This is roughly what your payments are. Now, why the bank would ever give you this chart? The last chart was you had to do a strict 30-year loan. You've already chose that. This chart allows me to see the difference if I were to pick a 25-year, a 20-year, a 15-year loan, and you can see the difference in price, but also the difference in what you're going to pay. Because now that I know what my monthly payment is, and I know I'm going for 30 years, I can take that times 12, times 30, and that tells me what I'm paying the bank back in the long run, right? But let's say my parents are like, well, I don't want to do that. I'm going to go for a 15-year loan. My parents didn't, they couldn't afford that. But let's say they do a 15-year loan. So same 80 grand, but they're going to go a 15-year instead at 12%. Okay? Well, fine. So the idea is that you have to go find your 80,000 for 15 years at 12%. It's $12, right? So that's $12 from the chart per $1,000 loan. So that means I'm taking out $80,000. So 80,000 times 12 is 12 times 80. That is a $960 payment. But how many years am I going out? 15. Well, if you actually want to see the difference here, 960 times 15 times 12, I'm only paying $172,000 for the home. What was the number I said earlier? 823 times 12 times 30. This was $296,000 earlier. that was a $296,000 home. If I took out a 15-year loan, look at the difference.
Wow.
Now, hey, if you actually see the difference in price though, if you want to see the difference in price, this is what my parents paid per month. If they would have just paid this, an extra $140 extra every month, I know that's kind of hard for some people to justify, they would have paid almost half in their home. That's why they always tell you, the lower the months you take out a loan, the better it is, the lower number of years. So if you're taking out a car loan, let's say, lower months the better. So 5 years, 4 years, 3 years, that's better than taking 6 or more. Most cars you can't go more than 6, especially older cars. I think the most you can do is 5, I think, anymore. I know when in this area, when the H2 Hummer came out, the Hummer vehicle, you could take out an 84-month loan. Okay, 84 months, 7-year loan, because they were $100,000 cars at the time. Now they're not worth anything. But you can see the difference. You don't want to do that. You're actually seeing a perfect example of what's happening here. So you can see the difference in price. That's why I'm telling you right now, choose less months, pay more. If that doesn't work in your budget, I seriously I would consider you to drop your cell phone bill and make the extra payment for your house instead. I know some people can't live without the cell phone. You can survive on Wi-Fi just the same. I always tell people, like, if you don't want to have a cell phone, get an Apple iPod, get an Apple account, and you can still message people through Wi-Fi using one of those, because it can still come across as a text message. Because now you're not paying a cell phone bill, and you can text and receive text as long as you're on Wi-Fi somewhere. Okay? That's not safe if you break down in the middle of nowhere, but the concept is that you're saving a lot of money. You're not paying a $350 cell phone bill some months, right? And you can take some of that money and put it back into a house where you're saving half the money in your home. Because I think the cell phone isn't worth $300,000, over the long run. Okay. All right. So now, okay, does everyone understand how the charts work?
Yes.
Okay, all right, let's talk about insurances now. All right, this next chart. Stop. So, all right, next chart. All right, this chart, I would like you, I know this is going to seem really difficult, I would like you to write this chart down. Do the best you can. I'm going to leave this up here for a little bit. You need this chart. This is our main focus today. Okay, this is mortality rate on housing. So, you need this. Like, write it down right now. Right now, because it's going away in about 5 minutes.
Can we just?
Nope. Hey, nope. Okay. All right. So what you're seeing here is the mortality rate on houses. So this is a policy if the person that took out the loan on the home were to suddenly pass away, be in an accident where they unfortunately died. This is the idea of what is covered by insurances if you buy home insurance. Most banks, when you take out a mortgage loan through your bank, they will require you to go through either their insurance company, or if you have your own, you have to have proof of insurance before that you can sign the final paperwork on that home itself. They transfer the rights to the home to you, and then you actually have insurance covering it before you move in. It's one of those things, like, you can get mortality like coverage on vehicles, on cars. It is super, super smart to do, especially if you're older, or if you know that you have a likelihood of having health complications. To always have mortality coverage on a vehicle or a home, in case you were to pass, then your loved ones don't have to pick up the difference in price and pay for the whole thing. Like right now, me and my wife, we split the cost on our mortgage. We pay half and half, basically. That's what we do, because that's just how we work. We have separate bank accounts, we pay half and half. We just thought that was easier in the long run, so we didn't have to change banks and change a bunch of different things around. On cars, you can do the same thing. So if somebody that signed the car were to pass away, the car is totally paid off instantly. and you just have to show your death certificate, which is really depressing, but you show the death certificate to your bank. They file the coverage, and getting that document takes a while. It takes about a week or two, so you have to cover maybe the first payment or two. But once you have it, you provide it to the bank, you provide it to the insurance company, and the insurance company will take over from there. They're usually really good about it, about how quick, it's especially on certain types of insurance companies. Now these types of coverages cover pretty much really anything that's involved. But the idea is that, again, this isn't like set numbers. These are just like kind of really rough estimates. That's why I kind of like this one. The next slide you're going to see kind of have some more. All right, so here's the idea. Let's say you're on a, let's go with 30-year loan like my parents had. Okay, so my parents had a 30-year loan. Okay, so $80,000 home, and they're going 30-year loan. Okay, so the idea is that after so many years on a 30-year loan, the insurance will pick up the slack as you keep going. Now, it didn't apply for my family, but my father eventually passed away from cancer. So let's say in year 20 out of 30, my father were to pass away that year. So in 1990, let's say, he passed. Okay, didn't occur, but let's say he did. Then the idea is that the bank would actually, or the insurance company would cover 55% of what's left. The reason why is you take $80,000 and you take it times 0.55, that's what the chart says. That's year 20 on a 30-year mortgage is 55%. If you actually multiply this is what's still owed left on your house, which is crazy. 80,000 times 0.55. This is $44,000 is still left owed on the home. Which I know you're thinking, on a 30-year loan, you're in year 20, and there's still 44%. Because they always say like the first 20 years, you're basically paying interest. After year 20, everything else is what you paid for the home, which is sad. Question?
What happens to their debt?
What?
Like debt, like if they have a debt.
If they have a debt, all debt is transferred to the next of kin. So that means if you were to have a bunch of loans, like credit card loans, car loans, if you have insurance, you're covered on certain things. But if you have car loan, credit card, student loans, that transfers. So let's say you get married to your husband.
No, if they pass away, like your parents and they like have like a debt.
It goes to the kids, and they have to pay, unless you have insurance. And that applies to kids as well. Like when you sign up for a student loan, and you were to pass away, unless you had insurance, your student loans would be tacked on your parents, and they would have to pay the rest of it off, even though you passed. It doesn't just go away. Certain companies, like my student loan company that I went through, if I were to pass, it's wiped, and my parents don't have to pay it. The next of kin would. But it depends on the company you go through. So credit cards you have to pay. So, all right. Questions on what this number is? This number, what I just found here, is what the bank will pick up and pay off the rest of the mortgage. That's what's left owed. Even though you went 20 years in, they'll cover up to 55% of that mortgage that's left. Because there is $44,000 left on that mortgage, which is crazy. Even though you went 20. If you had less term, let's say you went to a 15-year loan. Why does a 15-year loan only go to this bracket?
Because there's only 15 years.
There's only 15 years. You can't go 20 on a 15-year loan. You already have it paid off by then. So the idea is that the last year, look at this, the last year of a 15-year mortgage, you still have 9% of that loan left to pay off. That last year is 9% of your total loan.
Year one, so they get the money.
So, yeah, year 1, year 2, year 3, yeah, those are like the big years when you're taking care of all the interest. So, trust me, it's one of those things that you have to think about. Especially I consider myself middle-aged. this is something I'm seriously thinking about if I get my next vehicle or we get my next house. This has to be in my policy. Just because I know of like the burden that that puts on a family member if insurance doesn't have this covered. All right, questions at all how the chart works? All right, now, last part here. Okay, this is the last example. Now this is a really crude example, but this is the one I found in your book. So what you're having here, this is insurance on a homeowner in case of what type of home you buy. So what this is this is if these are your different situational areas. So they call these situations or areas of interest. So they have an A, B, C, and D, and yes, all insurance companies have this. It could be your like D is if you're in a high weather condition environment. So what I mean by that, so like if you're in a tornado valley kind of an idea, you're in coverage D. Okay, Iowa doesn't necessarily have to deal with that unless you're in southern Iowa a lot. We still have tornadoes, but it's not like a regular occurrence every week or every month. It's kind of once in a blue moon. Seriously.
Ant-Man.
No.
Please.
What's up, Pennsylvania?
Ant-Man.
Jurassic World.
Ant-Man.
Come on.
Stop shaking your hand.
Uh-oh.
Ant-Man.
I think it's Ella.
Alright, so.
Right there.
Alright, now hey. So, without the chart here, that's fine. We'll just kind of read it from here. Alright. There's 4 situational areas. Letter D, if it's a weather type environment, so hurricane, tornado, earthquake kind of thing, you can have higher insurance. One of the things in Clear Lake that you have to worry about is flood insurance. In case in certain parts of Clear Lake there is high risk insurance for flooding. It's over by South Shore Donut Company, where the big donut is around the lake. There's an outlet for the lake that dumps water out, and there's this little creek that goes out by the edge of Clear Lake. You drive over top of it. Most people never notice it unless you look for it. Those homes in that area are super high risk for flooding every single year. In fact, me and my wife were looking at buying a home back in 2011 in that area, and the insurance was going to be more than our mortgage was.
Wow.
And we couldn't afford it per month. It was we were looking at a home that I think it was a $50,000 home, but the monthly payments were going to be like $400 or $500 a month. The insurance was about $600, and it was like, no, we're not going to do that. We can save that money, buy a bigger home if that's the case we're going to do. Just because it was super high risk. It was every year they have risk of flooding. So it was one of those things we couldn't even afford the insurance. C could be a high crime environment. Maybe you're in a part of an area of town like, let's say, north of Mason City. It's higher crime rate. The insurance is higher there. It is, just by natural. Okay? And then A, maybe that's the optimum environment where there's, you still have weather, but it's just kind of just normal residential areas. Garner's pretty much considered that. I don't think there's any areas you really have to worry about. Garner. For flooding though,
Your phone.
that's fine. I'll talk about it here in a minute. Let's see. For Garner, the new development area that they're building out here is a high risk for flooding. Same with Sesame Street, that direction, high risk of flooding. So those are things we have to think about. We're going to look tomorrow at the rates that need to cover that. Okay? All right, that's it. That's it for today. Fred, you're probably getting called to the office. So here we go.
Cheese.